Good morning, everybody, and thank you for joining us today. Today, we're delivering the third in a suite of webinars looking at various aspects of employee ownership trust from both a legal and financial perspective. My name's Stuart. I'm a corporate partner at Clarkslegal, and I'm joined today by Adrian Howells, a director in the corporate finance team of Quantuma Advisory. Today we're going to look at the interrelationship of the board of directors of the company, which has been sold into an EOT, and also the role of the trustees of that trust. We're going to look in a bit of detail around the importance of financial skills and reporting in the context of the operation of the Board of Trustees, and also look in a little bit of detail as to why we should consider and put in place an employee council or equivalent representative group, and then also wrap up with some practical tips which we think you might find useful to give some thought to in planning the roadmap for an EOT exit. Before we begin, we have delivered a number of webinars before, and if you'd like to see them and you haven't seen them, please go to the Clarkslegal or Quantuma websites, or by all means contact us and we can arrange to send you those. Just in terms of the format of today, for those that haven't seen how we delivered these before, we will we will deliver the presentation. By all means, ask questions. There is a chat function on the software that we're using. We will wrap up by looking at those questions and doing our absolute best to give you some answers. So thank you. Thank you again for joining us. So the first area that we're going to discuss really and consider is just this relationship between these protagonists, the trustees and the board of directors of the company. So once the founders have disposed of the shares, they will be held by a trust. And that trust is controlled by officers who we call trustees, and the company will retain a board of directors that will be responsible for the running and day-to-day performance of the company. So the company really is designed to continue as it has done. The board of directors are responsible for the performance of the business and answerable to the stakeholders as a group, and that includes but isn't necessarily limited to just the shareholders. And the trust really is an entity that exists for the benefit of some of those stakeholders, i.e. the employees, and that is controlled by trustees who or a corporate trustee who are responsible for delivering the objects of the trust and managing the assets primarily on behalf of the beneficiaries. So quite often in an EOT structure you will see a corporate trustee introduced as the primary trustee of the employee ownership trust. It doesn't have to just be a corporate trustee, but quite often it isn't, and that corporate trustee can itself be controlled by directors. You can have individuals who control trustees, but generally people prefer to create a corporate trust structure because that gives some protection to the individuals rather than standing as an unincorporated trust. And quite often you can involve professional trustees to assist with the administration and performance of the function of the board of trust. So we'll come back to this, but I think it's important really to just identify what the trustees need to do and what is expected of them, both at law and quite often through a trust document. And those duties include, as I've set out there, an obligation to understand and promote the terms of the trust, so maintaining the assets, promoting the interests of the beneficiaries through the exercise of the shareholding, to treat beneficiaries equally, to exercise reasonable care and skill and judgment when making decisions on behalf of the trust, and also a need to avoid naturally conflict of interest with any beneficiaries or some of them. And their duties are similar to, but not exactly the same as those that you might be aware of in the Companies Act for directors. And a couple to note here in the context is that directors must exercise independent judgment when making decisions. They must exercise reasonable care, skill, and diligence, and they must avoid conflicts of interest. And if there are conflicts come up, disclose those conflicts in the context of the decision making process. So that's an overview of the duties and responsibilities. I'm just going to hand you now over to Adrian, who is going to talk about the importance of finance and financial skills in an ideal trustee.
Thank you, Stuart, and good morning, everyone. Thanks for joining us. So I'm going to look at the, as Stuart says, the importance of finance within an EOT. Three things I'm going to look at. So firstly, how the finance function might change within a business, choosing the right candidate to sort of head up finance functions, and just outlining what the finance function is responsible for. I feel like I've slightly got the easy shift this morning in that explaining the importance of a finance function to many of you will be a bit like teaching you to suck eggs, I suspect. But there is a serious point to this in that most EOTs are put through on smaller businesses, and those of you who have worked with SMEs, the greater extent to which a business is smaller, actually the less, I guess, professionalized maybe the accounting function might be. And so as a business transitions into an employee ownership trust structure, whilst for many businesses, you've already got what I might sort of call quite a grown-up finance function in place, and limited changes therefore may be required. But certainly for smaller businesses where finance is a bit of a back office function, it's not necessarily central to the day-to-day management of the business. Actually, that is something you would look to potentially change. And there's a couple of bits here. It's making sure that the trust has appropriate representation amongst the trustees in terms of financial acumen, but so too actually the day-to-day management of the business requires this. So really finance becomes, as I say here, sort of central to the governance of the entire organisation. It's particularly important because, although we're not discussing this in any detail in this particular webinar, but we do, in the previous webinars, and as Stuart said, we'll share the links to those. But the way an EOT is typically structured, a lot of debt is involved, at least from the sellers, who tend to leave a lot of their value essentially on the balance sheet of the business in the form of effectively vendor loan notes. The idea being that as the business trades, it is able to essentially pay these loan notes back to the vendors, and that's essentially how they tend to get their consideration. Now, the payment of those loan notes needs to be affordable, manageable, realistic for the trust, and so that is only really down to the finance function to make those decisions and to sort of make sure that the financial information is there to enable the right decision to be made by the trustees to sort of pay out the debt to ultimately to the vendors. This becomes even more important where you've structured an EOT using bank debt. And again, as we've explored in other webinars, as a vendor, one can accelerate the value off the table effectively by using bank debt to sort of get a slug in of debt up front from the bank. So your vendor loan notes are that bit less. Of course, the debt to the business is the same, just now some is owed to the bank and you as a seller have had that money. Of course, banks are very thorough, prescriptive and diligent in terms of what they require from businesses taking on money from them. And so, the central point is, and as I say, it's not applicable to all businesses because many will have this in place in the first place. But for smaller businesses, often, we will need to put in a proper finance function. And moving on, well, who needs to be involved? Well, ideally, you're going to have a finance director coming in. Again, plenty of businesses will have one already, but plenty, may not. The ideal candidate sort of doesn't exist. I mean, you'd ideally want an FD with lots of prior experience and within an EOT sort of environment. But because EOTs are relatively new, I mean, they've been around 7 years now, but there's not a great volume of them yet. And so, finance directors with relevant experience are pretty rare. So, you're not necessarily going to tick those boxes. Don't overlook your existing FD, but equally, don't necessarily automatically default to that. This becomes a little bit not quite controversial, but it's a challenge for the owners some owners at least to work through, in that the FD might be someone you've known for 20+ years, and emotionally, automatically that's who you would want to run it. But actually, if they've just been running a bit of a light touch finance department for you for all these years, rather than something quite rigorous and sort of professionalized, actually it might be that your current FD is not the right candidate. I think those involved in finance, both within the trustees and on the corporate board, it's not just the technical skills that they require, although they become very important because of these sort of burdens of debt essentially that need managing, but also soft skills are at least as important. There's various conflicting interests within an EOT, albeit ideally everyone's on the same page and it's largely a sort of a virtuous circle. But actually, if things don't go so well, there are potentially sort of 4 interested parties, being sort of the beneficiaries of the trust, the staff, the sellers themselves who have got debt in the business and therefore a vested interest in that debt being paid, the trustees, and of course potentially a third party lender. And so you can easily foresee situations where a business isn't performing quite so well, where the interests of one party aren't 100% aligned with another. And so, the person sort of at the tiller of the finance function needs that sort of soft skill of what I've called here sort of emotional intelligence to sort of almost feel and foresee things bubbling beneath the surface to try and get ahead of them. Communication is absolutely critical, across all those stakeholders, and then also the ability to hold and bring people together to sort of work through pragmatic solutions and make sure everyone's on the same page and pulling in the same direction. Finally, and depending on how a trust is structured and what's happening with the vendors, it might be that you're sort of very much an owner-managed business and you're very much stepping away, you're no longer going to be involved in the day-to-day running of the business. Well, who now will have the strategic and visionary oversight, if you like, to help drive the business forward and ensure its commercial success such that it can pay out the vendors and of course, trade well long into the future. And so again, a finance director or members of the finance team who've got that sort of that skill set as well, I think are well worth singling out as potential candidates. I'll jump to the next slide, please, Stuart, and just run briefly down, and again, for the accountants on here, I apologise, this really is sort of back to college, but nevertheless, it's worth, I think, just reflecting on what that finance function is now going to be responsible for. And this is by no means an exhaustive list, just sort of an examples of things that aren't necessarily always present in smaller businesses. Certainly, this is more from experience, having dealt with, hundreds of them over the years. So we need to be producing a board pack, essentially, which will comprise monthly management accounts, and that should be a profit and loss account, a balanced balance sheet and a cash flow, all reconciled together, and also sort of reconciled against your budgets and your forecasts to sort of track how we are doing against plan. Of course, we need to pull that plan together as well, and not all businesses produce budgets or forecasts. Actually, once we are responsible for managing all this debt, particularly if we've got a bank in place, actually this is going to be quite a basic requirement, so we need to make sure we're able to pull this together. Obviously, hiring finance staff, again, it depends what sort of size finance function we're starting from. If you've really got everything in place, as I say, you're not going to see much change. But if you're quite small, it could be that we're hiring staff so that the FD's got support to run the finance function. Making sure we're compliant with generally accepted accounting practice seems obvious, but plenty of small clients I deal with are not, particularly in terms of income recognition for sort of SaaS contracts or things like that. Very often that's not dealt with properly. Well, going forward, that needs to be, all in line with applicable standards. You're going to, as I said earlier, you're going to provide strategic input into the board of trustees and into, the general direction of the business. Coming back to communication skills, we need to keep an open dialogue with lenders. That's part of that is just provision of the monthly reporting pack. Part of that is flagging problems in advance that might need dealing with. And by lenders, I guess it's worth saying that's not just the bank, that's also, initially at least, that's the sellers as well. And finally, what's finance responsible for? And it's balancing the interest between those sort of four stakeholders. I noted earlier, when the wind is behind you, actually, generally everyone's interest is in the same direction. You've got agreements in terms of how this thing is structured and how people are going to get paid out, and everything's fine and everyone's happy. Headwinds can produce a bit of a challenge, and being able to sort of balance that, manage that through, I think is a key responsibility for the finance function. And so with that, I shall pass you back to Stuart.
Thank you, Adrian. There's some points there that I'll comment on a little bit later. I think it's just useful, really, just to sort of set out in our minds that you have the company with directors that's ploughing away, generating its money and income, and it's ultimately answerable to a group of people. You've then got the trustees and the trust, who represent, if not all the shareholders, a qualifying interest. Quite often, the company will set up the trust, or it will be set up as a package of documentation, and we therefore start considering whether or not we should have something between the company and the trust itself, and why, really. And the purpose of this section really is to outline the thing called the employee council and why we might have it, and to identify some of the issues that can come up if you don't, in and around conflict of interest, which will loop back to what I was sort of saying at the beginning with duties of both directors and trustees. So why do we have a council? There's no specific requirement to have one, but as I say, if you don't have something between the company and the trustees, by virtue of the trustees being a majority, or if not the complete, representing the complete, if not qualifying interest of shareholding, they, under the Companies Act, have the ability to control the board of directors of the de facto company, the company that sits there. And the trustee is usually a corporate, and that is effectively owned and created by the company. So the company would therefore have power to remove directors of the corporate trustee. So you can see it becomes very circular, where there is a clear conflict of interest by trustees who might want to appoint directors who would look favourably on decision making and appointment of corporate directors to the corporate trustee, and vice versa. So bearing in mind what I said about duties to avoid conflict if you're a director, and the ability to exercise independent skill and judgment if you're a trustee, you fall foul, or potentially fall foul, of the conflict of interest rules. So what do we mean by a conflict of interest, and what are the implications of trustees making decisions, or directors making decisions without regard to their conflicts of interest obligations? Well, you might have come across the terms void or voidable. The decision itself is void. That basically means it's ineffective. So if there's any contract entered into which is void, it's ineffective. It's as if it never existed. If it's voidable, the innocent party has the ability to elect whether or not to enforce the terms or otherwise. I wouldn't be. It wouldn't be right preparing and delivering a webinar from a law firm without citing some case law. I do try and avoid it as much as possible, but the Road Chef case that I referred to in there is a very useful illustration of how directors and trustees can get themselves in difficulties, and a good example of what happens if decisions are held void or voidable by the court. So I throw that in there. The other thing to look at is, if you have a corporate trustee, then you might think that because you are a director of a corporate trustee, a corporate trust, and the corporate trust itself is in conflict, you wouldn't have personal liability as a director of that corporate trust. And whilst it was established a long time ago in Bath and Standard Land, the directors themselves do not owe direct fiduciary duties to the individual shareholders or beneficiaries. In that case, it involved an investment, financial investment trust. That has over time come about the concept of a dog-leg claim, as it's known, and the idea is that, well, the ability for a breach of duty claim to be brought by a company for the breach of duty of a director is fundamentally held on trust for the beneficiaries of that company, and therefore there have been cases, and I refer there to Al-Amrani, which is a case heard in Jersey, and also Gretton and HAE trustees, where this type of action has been used to by disappointed beneficiaries to uphold standards of directors of corporate trusts. So I think that's enough law, really. But as I say, the point is that just because you're a personal trustee, just because you're a director of a corporate trustee, doesn't mean that your obligations with regards to the ensuring that the corporate trustee performs its obligations in accordance with trust law and the trust deed necessarily fall away because of the corporate veil. So, as I say, without that conduit between trust and company, there is a circular issue where officers can be exposed and trustees can be exposed under conflict of interest issues, and therefore employee councils are a concept that are included in the legislation and pretty much embraced by most people considering a trust. It's made up a number of employees. It doesn't have to be a council, it's a representative group. And ordinarily within the trust deed itself, you will have a very broad skeleton of constitution, saying that it needs to be made up of a couple of members, that they themselves at their first meeting will decide how they will meet, how often they will meet, how decision making will take place, how people or members will be appointed to the council or resign from the council. And it will also express a number of powers that will be granted to that council, and typically decisions regarding the appointment and removal and agreed remuneration of trustee will be delegated. The ability for the trust itself to decide to sell its assets or shares to in the company to a third party, they will need to be deferred or consulted with, and consent required from that council. Similarly, if the trust owns only a qualifying interest of the total shares, and there's an option to, or opportunity, and when I say option, I don't mean a legal option, an option to purchase some additional shares from founders. Again, their consent ought to be sought, and similarly, if there's going to be any subsequent amends or variations to the constitution of the trust, the trust deed itself, again, their consent ought to be required. So I'll just wrap up by highlighting a number of points really that as an advisor, both Adrian and I have generally regarded as important things to consider in the approach or run up to an EOT, or managing the process, and a sale that we think are quite unique to an EOT rather than perhaps a trade sale. Choosing the team, it really is important to identify the key protagonists early on. We have to think about, unlike a trade sale where you're not really that concerned about how the buyer structured once it acquires the company, as long as you're getting your money and you have appropriate securities in place to ensure deferred consideration is paid. You have to think about these directors, you have to think about the directors going forward, you have to think about who the trustees should be, might look like. Adrian talked eloquently about the role of the finance director or manager, perhaps having to move position, if you like, into the role of a trustee if they're appropriate. If that's going to happen, it's very difficult really to have an existing director of the company sitting as a trustee of the trust. So you may well need to think about their role within the organisation, how that fits going forward, as an example. Consultation and communication, it really is important to start those discussions early. To maintain the culture. When founders are leaving any business, it's disruptive, it's difficult. Getting your key team in place and working out how best to disseminate that information and cascade it through the organisation is really key. And remember, the last person that hears about this will be going through all the concerns, issues, anxieties, worries that you had when you first thought about it as a seller. It just means that at that stage you're sort of through it and are moving forward. That person who's still vital in the organisation, who's the last person here, sort of needs that support really, because it's new news to them, and you must try not to lose thought of that. And it may well be that you think about how you're going to communicate the project on day one? Are you going to take people away on an away day? Are you going to, as your business is a size where you can tell everybody at the same time, this is the structure, this is what we're going to look to do? Or are you going to break people down into consultative groups and have a committee that's responsible for delivering that out? Again, that's something that's really important to consider with your leadership team. The collaborative approach, you know, trade sales involving documents going forward and back and disclosure letters going forward and back. If you've seen the previous webinar, apologies, but I'll make the point again that the way in which, you know, founders deliver this, or should deliver, in my view, the EOT is a package of documentation with sale and purchase agreement, a reasonable attempt at the trust deed, an explanation flow chart, you know, data room access, dealing with DD that you would expect to see in a form of buyout or management buyout or buy-in, and of course evaluation. It's about sitting around with people and then taking them through the documentation and dealing with issues collectively rather than in a traditional, you know, them and us adversarial is a bit strong, but a them and us approach from a transaction management perspective. I repeat the point, really, it's important to think about how your key players are going to play their parts in the new world, with trustees, councils, directors, and board, having regard to their independent or individual obligations, needs, and employment rights and obligations. Again, council or the representative group, for me, it's a given that there should be a council. How small or how large is a question of fact and degree and detail, but I think I hope I've illustrated the importance of having that council and why you would want one. And then you know, you may well want to consider change management training, speaking to consultants. This isn't a legal point at all, but I think it's a very important one. I have seen instances where organisations of a size are bringing in change management consultants to help everybody with the trauma, maybe a bit strong, but the anxiety and worries of the fact that the leadership and management team are changing and the business is transforming. Because if you get this right, all the indicators are EOTs promote profitability, staff retention, healthier and happier workplaces. So everybody wins. So I make a footnote to that. Right. Well, thank you. Thank you for your time. We're happy to field any questions that we may have, and I'll just have a look at those now. We've had a few coming in. One question I've had is, can former owners, or so I suspect by that they mean the sellers, be trustees or directors of a corporate trustee controlling an EOT? Adrian, did you want to comment on that before I made my point?
I think that's more a legal point.
Yeah,
to be honest. Stuart,
I strongly against it. I don't think they can. I think because of the conflict issues, I think because of the change of control points that are underlying to the success of an EOT transaction from the tax side of things. Former owners or directors, former owners should not be trustees of an EOT, or they shouldn't be directors of a corporate trustee. It may well be that.
I was going to say, certainly from a commercial perspective, Stuart, I think that's, you know, that conflict could become, when I was talking earlier about, you know, these various facets pulling in different directions, I think trying to make them all one and the same person isn't the right answer to that. And yeah, but it is more a legal point, but I think commercially it doesn't make a lot of sense, to be honest.
No, no, and it may well be that you can, they can of course still retain positions on the board of the company as long as they don't control the company, and whether that's as an exec or non-exec. Indeed, if there's bank funding in place, I'm pretty sure the bank would be very positive about that level of involvement to give that continuity, certainly in the short term. Another question, is there a minimum number of members who should be elected to the employee council? I guess by members, talking about members of employees, perhaps. I think it depends. I mean, I'll take that one if you like, Adrian. I think it depends. I think you'd certainly want more than 2, but you wouldn't want too many. You just need to make sure that you've got a good representative group who have the requisite skills, knowledge and expertise to support the trust and the trustees in their decision making, and of course can disseminate that back to the employees excuse me, as a whole. We do have another question. How do the mechanics of the tax-free bonuses out to staff take place? Adrian, would you like to answer?
Yeah. I guess there's 2 bits, and the first bit, the literal mechanics, is it would go through. You put it through payroll, with a simple thing to do. At what point during the year is probably a commercial decision to be made. I'll need to double check, but I think although these aren't dividends, there is rulings around distributable reserves and priority. So it may be that the business needs to have distributable reserves in order to be able to make those payments. But I'll double check on that and get feedback.
Okay. Yeah. Thank you, Adrian. Thank you. Well, I think we've had all the questions that people wanted to ask today. Of course, you'll see on our screen there that we have given you our numbers and email addresses, and if there is anything that you would like to ask, or that if you haven't already and you go back and look at the previous webinars and you'd like to ask for questions or clarifications, please do reach out to us. We're always happy to have conversations. I think both I and Adrian. So thank you for giving up your day and giving up some of your time this morning to listen to us. I hope you found it useful. That only leads me to wish you well and good luck as we approach Easter in the warmer weather, and thanks very much for joining us. Bye for now.
Thank you very much.